Welcome to the Market Edge Tech Talk with Will Pauly and special guest David Blake. We're going to review the market conditions of the past week as well as longer-term trends from a technical perspective, take a closer look at the major indices, and to wrap it up, dig into a handful of individual stocks and ETFs requested by subscribers. If you have questions or want to submit a stock for next week's webinar, email us at support@marketedge.com.
All right, so David, what's been happening in the market since our last Tech Talk?
All right, well, last week after Monday's surge, the market traded mixed over the next couple of days. There were some political headlines and interest rates moved a little lower on dovish comments from the release of the May FOMC meeting minutes. And then as the week ended, we had a drop in energy after OPEC and Russia said they were going to increase oil production. That hit the energy sector for about a 2.7% loss. On the flip side, we had stronger moves up in technology and consumer discretionary, which outperformed due to earnings. However, we did have some problems here Monday. As you saw, we had some political turmoil in Italy and Spain. That caused the market to sell off rather sharply. The Dow Jones was down 505 points intraday. A lot of that was due to a pickup in the U.S. dollar after the euro really sank on the news from Italy and Spain that there may be some problems with in the eurozone. Okay, the euro was lower. The U.S. dollar jumped about 4%. In turn, that caused the yields, and in particular the yield in the 10-year Treasury, to slide from down to 2.78%. If you remember, it was just at 3.1% just a little bit over a week ago. We'll look at a couple of charts here shortly and see how that's going to affect our investments here and how what we can do while that plays out. But yesterday, the financials were down more than 3%. I think it was about 3.4%. We are getting a pretty nice bounce today. I think we recovered about 2.5% today, so that's good. That's we bounced back a little quicker than I thought. We are getting some the coalition parties are forming a new government over there in Italy that looks like they're going to work together. That's causing the yields in Italy to come back down and cause our yields to go up for a little bit. So we'll also look at the financials here in a minute. But just to go over what our market posture is, currently we have the CTI at a bullish plus 14. We've been talking for the last week or two that it's likely that we'll probably make a run to new highs in the different markets. Momentum is positive at a plus 5. That means most of the other indexes are outperforming the Dow, which is a bullish scenario. And sentiment has been reined in a little bit, and we are currently at a neutral 0.
What can you tell me about the major average?
Well, let's take a look at some of the charts on the major averages here. First of all, we're going to take a look at the Dow Jones. Let's see if I can get this to about 6 months. All righty. First thing is not real good. First thing I see over here is where we broke out about a couple weeks ago. Had a nice move up, and we kind of created sideways, consolidated some of the gains. This shows yesterday's little sell-off. I really can't tell from this too much, but it was a lot more than what this little blip looks like. Today we've recovered, about 3/4 of that. We are seeing some deterioration in the in some of the indicators. Let's see here. We have, this is a RSI. That's pretty neutral, and the 30-day stochastic is still in pretty good shape. A little bit deterioration over there. Okay, you saw over here yesterday. For the last week or so, we've been struggling up here at the 100-day moving average. We got this nice breakout. Okay, hold on. Let me draw the trend lines back in. Okay, so here's, yes, you can see over here after we broke out of this triangle pattern, we had the Dow Jones moved up to its 100-day moving average, briefly, bounced off of it, and then we went across it, and then it's been struggling most of last week to get through that resistance area. Yesterday we came down briefly, traded below the 50-day moving average, which is a bearish technical event. However, we were able to pretty much close right on it, and today we've recovered that amount. So. We're kind of going in a little bit of a sideways trading range on that. The accumulation, which we can look at on that, let's market recap. Okay, we see good on NYSE advanced decline line. You can see it's a nice accumulation in this. This just means that more stocks are participating in the move up. Shows a lot of stocks are under accumulation. Had a little bit of a pullback yesterday or last week, but this is starting to move a little bit higher. But we don't quite have confirmation from the NYSE new high, new lows. You would like to see something like this expanding. Back here when we were making it, went to a new high, we saw the number of new highs getting up 300, 400. Okay, well, right now we're at, we had more new lows and new highs yesterday, which you'd expect. But before we can, we'd like to see this getting more traction, start to see the new highs expand. That shows that there's a broader number of stocks that are hitting new highs. I looked yesterday, the stocks that we follow currently, that we're at about 13% of the stocks are within 1% of a new 52-week high. Back here we were at 20%, 22%, which meant it was a strong market. Of course, then it rolled over at some point. But this we want to see pull over, or I mean start to expand, and that would be a little bit more of a confirmation that we're confirming that we're off the new highs. Next we'll look at is the S&P 500. So we can draw some things in here. Okay, this is I'll see the triangle pattern on this also. Okay, and here you can see that we broke out of that triangle pattern on the S&P 500. Yesterday we fell back down. Here's the 50-day. Now this is the 100-day. We broke above that, came down, tested that 100-day moving average several times over the last couple of weeks while the S&P traded sideways. Yesterday we broke below it, came almost down to the 50, bounced off that, and today we're back above that 100-day moving average, which is a plus. We want to see that going on. There is support down here. You can't see it, somewhere down in here around. Well, let's see. 270 around the 100, around 2670 would be support. You want to keep an eye on that. If that would somehow break here over the next couple of days by, say, some more turmoil in Italy, that could induce some more selling. So that's the support level we want to watch, which coincides pretty close to the 100-day moving average. Okay, now we'll look at the NASDAQ. Okay, now here you can see on the NASDAQ, we're a little bit better shape here. Now we've actually been in a pretty tight trading range here after we broke above the area where the Dow and the S&P kind of broke out of that. Where the S&P and 500 and the NASDAQ broke above their out of the triangle range, and now it's been trading sideways here for about the last 2 or 3 weeks. However, we are getting good accumulation in that thing. Anyway, you can see over here that these are actually positive. The momentum indicators are positive still for the Nasdaq, even though we're trading sideways. And what's important about that is that you can see that most of the stocks are under accumulation while we're in that sideways period. That's actually a fairly bullish type of thing. We're both, if you look back at the chart of the Dow Jones and the S&P 500, you'll see something that's similar to this, and that we're now back to making higher highs and higher lows, which is a bullish condition. Also on the Nasdaq, we're not expanding on the number of new 52-week highs, but at least we're still making more new highs and new lows at about a 2-to-1 clip. So that's again showing that more stocks are leading to new highs. Okay, the next one will be the Russell 2000. Okay, this is the small cap index. As you can see, actually is making a new high today. We completely took out the old high that we had made just the previous Monday. And as you can see over here, we came down, tested this breakout area. This is called polarity, when the old resistance becomes support. So we traded down to this line yesterday, bounced off of that. We're up about almost 1.75% this afternoon, breaking out to a new high. 14-day RSI is positive. It's 64. So we're getting as of today, we're probably overbought on this one, but it still looks strong. It's the strongest chart of all the different indexes. There's several reasons for that. Number one, the small caps tend to benefit most from tax cuts. Number two, because of the strength in the U.S. dollar, which is hurting the multinationals, the small caps aren't affected by the stronger dollar as much. So all this, the political turmoil and that and the trade talks are not going to affect the small caps like they are on the especially with the Dow Jones stocks, where almost all of those are multinationals. So that looks good in here. It's under good accumulation. One thing we do want to keep an eye on with these things would be keep an eye on the costs, on material costs. So that would affect the small caps as we start to see the commodities index, which has had a very nice run. If that gets too strong, that'll start bleeding over into the small caps and could limit some of their growth.
Now, the Russell 2000 is breaking out to new highs. Why are small caps outperforming? Can I use Market Edge to find good small cap buys?
Yeah, you can. When you're buying the small caps, it's good to find a good list of small caps. We don't really have anything that fundamentally will find them. But if you go and do a Google search, you can always find the 100 top fastest growing small cap stocks in the U.S. or something like that. If you take that list and put them into Stock Watch, this is my list of small cap growth stocks, and I can take this report and find out which stocks have been upgraded or downgraded. These are going to be fundamentally sound stocks and also technically. What I would like to do, I'll try to arrange these things by strongest to weakest, by 50-day relative strength. Or you can go in here and take this list and try to find them, sort them out by upgrades, downgrades, early entry buys, best longs, that type of thing. And what you also want to do on these, after you get a list of, say, the top maybe 15, 20 stocks that you want to take a look at them and see what industry group they're on. You can come up here and take a look on here. You take the relative strength on the industry groups and take anything that's outperforming the market. Say you go into the top 10 industry groups. Number one, you can also find stocks in here, but you don't know if they're small cap or not. But then you can find out what sector or what industry group those stocks are in. You don't want to, if you find a small cap stock that's in the office equipment or savings and loans or something like that, you probably don't want to go into buy that at this time. You want to stay where the momentum is in the market. In that case, you get your list off of Google, put them into a stock watch list, sort them by, like I say, upgrades, downgrades, however you want to get them, early entry buys, and then you can match them up with a strong industry group. And that way you're going to have the best of both worlds. You have something that's strong fundamentally, something that we like technically, and you'll take a list of maybe 100 stocks and come up with a list of 4 or 5 that are good buys today. I want to show one other chart on here real quickly. So I pointed out a couple weeks ago that the Dow Jones Transports were close to coming out to a new high. Now, we don't have the transportation index point and figure chart, but I want to show you this. This is IYT, which is the ETF for the transportation average. And if we go over here to the point and figure chart, which you'll find in the stocks module, okay, you see over here we have 1, 2, 3, 4. This is called a spread quadruple top in the point and figure chart, a bullish pattern. And as you can see on this, we are in a row of positive X's, which means it's on a buy. And one of the things you can do on this, if you count vertically, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15 rows across, and then start to count up from here. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. It's going to show that our target will be up here where the old high was. So I'd expect to see the Dow Jones Transports be one of the leaders to break out to the new high with the Russell and NASDAQ very shortly here. And that will be bullish for the broader market. That probably would, if you look at that, that's probably what we're calling for, a summer rally in here pretty soon. And we've had a couple of hiccups over the last 2 weeks with the energy deal going on, and then of course the financial thing yesterday. But keep an eye on that. Like I said, we are still in a buy pattern, and I think with the Dow Jones, the transport's having a big day today, and that's bullish for the broader market also.
So you've been telling us about the strength in the U.S. dollar in the office a lot recently. Can you tell us a little bit about that?
Here's the U.S. dollar. We're going to just tighten this up a little bit. Actually, let's go back 5 years on this. I want to show this first. As you can see on this chart, we recently just yesterday actually, we got a nice pop on this with the problem with the euro sinking. We did cross back above the 50-day moving average, and one of the things, although it's moved a lot. If we go back here and we take the move down from the start of 2017 into February this year of 2018, you can see that so far, besides taking out the 50-day moving average yesterday, we now have retraced 50% of this whole move down, which is kind of where you would expect the U.S. dollar to maybe struggle a little bit. But if we do go above that level, which on the ETF it would be above the 25 area, it could cause some more problems for the broader market as well as for especially for the multinationals. Multinationals do what they have when they bring over their revenues and earnings. They are going to have a currency exchange problem, which can cut off anywhere from 7 to 8% of their earnings from overseas, and that is probably one of the reasons why we have not seen, despite double-digit earnings growth and expected digit earnings growth again next quarter, why we haven't seen upgrades or to the estimates, especially for the multinationals. Because if the dollar continues to go up here and it takes out that 50% retracement and retraces the whole amount, it's still going to cause some problems for that. It'll also cause some problems. Although on the flip side, it can keep the cost of commodities down, which would also take care of some of the inflation problems that we're looking at right now, where inflation seems to be picking up. If the dollar can get stronger, that can limit the cost of materials, because, as you know, the commodities trade in U.S. dollars. So that's something to kind of watch. It's a kind of a double-edged sword. It's going to be good and bad. The small caps and all, again, should be able to outperform even if that goes higher, but it will cause some problems for some of the bigger companies that do business overseas.
What about emerging markets?
Good, good question on that, because emerging markets, the stronger the dollar is, um, the weaker the emerging markets are going to be, because they can't. That makes their the commodities more expensive to them to get over here. And our goods are going to be more expensive for them, and that's that. If you look at the, let's do a comparison here. Here's UUP. Let's compare it to EEM. Okay, you can see this is an inverse relationship. Okay, where the dollar is moving up over here, emerging markets start to head down. Every once in a while, you're going to get a pop that'll go away from it. But here, the U.S. dollar is kind of going sideways. Emerging markets are falling out of bed. Okay, now as the dollar starts to roll over here, we're starting to pick up with the emerging markets. And as you can see, they took off here over this last year, peaking in January, where our dollar had fallen down to its lowest level since about 2014. So if this dollar continues to go higher, you're going to see the emerging markets continue lower. It's not a place you want to be at this point. I know a lot of the talking heads are talking about, look overseas. Those economies are behind the United States, and that may be where you want to be going forward. No, I don't think so. Like I say, if the dollar continues to get stronger, especially against the euro, emerging markets are gonna give back some of that gains that they've had over the last 2 years. So I would not be a buyer of the emerging markets yet at this point. Now today we're also going to bounce back in energy, which was hit pretty hard the last couple of days. I would still own the energy stocks, oil related stocks. You still have. I know that the OPEC and Russia want to continue to put up more output. However, you're still getting sanctions on Iran. Russia still has sanctions on it. Venezuela is basically out of business. So we can take on a little bit more supply at this time without hurting the oil stocks. Most of those stocks are still trading where they were when oil was trading at about $32, $33. So I believe there's still upside for the oil-related stocks, especially the refiners and that type of thing.
All right. So I think it's time that we move on to some customer questions.
Okay.
So I've got a couple here. NUGT and XBI are the two that I've got.
Okay. All right, let's take a look at XBI. That's the I guess the S&P biotech index. Really doesn't look much different than the say the S&P at this stage. I do like the biotechs, and I also like the healthcare in here. You're seeing some nice, little higher highs, higher lows. You can draw in a trend line from the bottom over here. I wouldn't really say we're in a channel yet, but we're kind of in a channel right here, moving higher. We're trading above the 50 and 100-day moving average. The momentum's still positive. 30-day stochastic, which I like to show how strong the trend is. We're still up here above 80. Anything above 80, that means you're in a pretty strong trend. So I like the biotechs in here. Again, when we talk about these, I always suggest that you buy a few of them and make yourself a little basket, so you don't put all your cards, everything into one basket. Just because these things are volatile, you get something that's moving up on anticipation, they're going to get an FDA approval, and it doesn't come through, the thing loses 50, 60%. So if you have 4 or 5 of them, all you need to do is have one that really gets a new drug passed, and you're going to more than make up enough money for all of them. If you happen to get 2 or 3 that come out good, good for you. Okay, somebody else had one nugget. Okay, this I don't really care for gold in here. I think that as we start to move out, get back a little bit better shape here with the broader market, you're not going to see much going on with gold, especially if our interest rates start to move up some more. Now you've been pretty much at a pretty tight trading range going back here into February. You can draw over here on the upside. Let's go up here. That's On the upside, you're around 28.75. On the low side, you're down here around 24. So in this just narrow range. In fact, if you can get gold or something like this up to around the 200-day moving average, which still needs a good way to go, I would probably think this would be a short if you get up to the top of this range again. I see gold probably, if you look at the GLD, probably going back down into into the 1285 area, down from 1350 a couple weeks ago.
All right, well, that's all we have for you this week. Tune in next Tuesday, June 5th, for another Market Edge Tech Talk. Thank you, and have a good week.